Hello and welcome to Trading the Trend. My name is James Boyd. We welcome all of you here today on this Thursday morning or afternoon, wherever you are. Hopefully you're in some nice sunny weather. It's going to be 60 here in Salt Lake City this week on Sunday, so we're looking forward to that. So it's almost time for spring baseball, and many of you looking forward to get back out. So let's get started here. Now, this class is Trading the Trend. Now, it doesn't say trading the uptrend. It doesn't say trading the sideways trend or downtrend. It's whatever the trend is most currently happening and where we think it could go. So in this class, most of the time we'll talk about bullish examples, okay, most of the time. Sometimes we'll talk about strategies that might be a little bit more neutral. So we tend to look for strategies that have a delta of maybe 30, 50, 70-ish, probably at the minimum. And then sometimes, of course, we talk about buying stock, and which would have a delta of 100 if we bought 100 shares. So this class is mainly focused on bullish strategies, but from time to time, we'll talk about adjusting that kind of perspective and delta. Now, just real quick as we get started here, we got Brent Morris in the chat, fellow instructor. We welcome him. And you can follow Brent and myself on X as we post kind of examples and also updates throughout the day. So check those out on X. Now, remember when we talk about stocks, it's provided for information, and also it's not considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. When and if we talk about options, remember that options can carry a high level of risk, not suitable for all investors. Also remember that investing involves risk, including loss of principal. And also remember when we talk about options that are sold, like sold calls or short puts, that's an obligation. And with that obligation comes what we call assignment. If you sell a call, you got to deliver the shares at the strike price, irregardless if it's at expiration. You sell the put, you could be assigned, which means, well, you could be the buyer of the shares at the strike price, irregardless if it's at expiration. The examples we talk about are American-style options, and that can happen. Now, also remember when we talk about options, reference the option Greeks and know what they mean. We'll bring that up here today more fully. And also, quick reminder that next week, we'll be down in Scottsdale, Arizona at the Phoenician, okay? Very nice place, and so it'd be a great opportunity for you to actually come live and see us on March 7th and 8th. Chicago, Advanced Option Strategy Workshop, 21st and 22nd. Renaissance Schaumburg, and also Detroit, April 11th and 12th. So the first day of these workshops, live events, is technical analysis, and the second day is option strategies. If you'd like to learn more about that, and go to schwab.com/events. Quick reminder that these events do not have unlimited capacity. So once they are full, they're full, okay? Now, just real quick as we get started here, I want to kind of talk about some of the things that we're going to bring up here today. So I do want to kind of talk about, just do a quick follow through on NVIDIA, how that's actually playing out with the semiconductors, and then look at the NASDAQ. Want to kind of talk about kind of like the market posture in terms of maybe changing the types of strategies that we're talking about, okay? I know sometimes we're always talking about, I'm just going to buy stock, I'm going to buy stock, I'm going to buy stock. But is that always appropriate? Always? Maybe it makes sense to kind of change some strategies. We'll talk about why. Now, also, when we do that, we'll talk about some of the sectors and kind of some of the stocks that are kind of doing something different than the market in general, okay? And because this class is mainly looking for neutral to bullish examples. Not always, but a majority of the time. So let's kind of take a look at this for just a moment. Now, I think one or two of you asked about kind of cursor size. I made my cursor bigger. Also, second, when I kind of move, I'm going to kind of do like that, so you can kind of see exactly where I'm moving to. So I did read your comments, and hopefully that helps to follow along. So first off, I'm on the Market Watch tab. I'm on quotes. I'm looking at the indexes. Now, when we do this, we're always trying to get a sense by looking at the trend column first, okay? What trends are we in? Well, whenever we look at the trend column and then we actually see that the only thing that is, it's so funny, but it's not. Okay. When the VIX is trend 3 and all the other equity indices are trend 1, that's not nice. Okay, so clearly that tells us many of these things obviously have fallen down below their support levels, moving averages, and they are probably starting to near some of the horizontal support areas. Now, You got to remember something. When markets pull, when the VIX is up above 18, that's when the investors start to go look for some stocks that could be attractive. Now, if you just kind of took a mental break typically for 2-3 weeks when the trends on the indices were in trend one, you're going to tend to miss the tradable bottoms. So you actually start watching when we're in trend one because, well, that's when you could get the biggest percentage snapbacks to the upside. Okay? Now, I want to kind of point this out. When we look at the relative strength column, because the reason why I say that is volatility doesn't last forever. It tends to be mean reverting. If it's up a lot, it tends to snap back down. If it's down a lot, it tends to snap back up. Mean reverting, okay? Now, when we look at, let's say, the relative strength, where is it? Well, in the last 5 days, it's been the Dow Jones, okay, and the S&P right there. And you're going to see that below that is just Russell, NASDAQ, and there's the SOX. So really, in the last 2 days, it's really been the Dow Jones and the S&P 500 trying to find some footing here. Now, when you look at the whole moving average columns, HC for whole counter, meaning it's looking at the color of the moving average and then counting the number of days, we can see that they're all red outside the VIX. Now, let's take a quick look on this NVIDIA for just a moment. NVIDIA, which we have 2 positions on, we'll talk about. You're going to see that it kind of is more neutral, but it popped to the upside and then faded. So far, kind of a muted reaction. The key word is so far. Semiconductors, well, smashed back down near the horizontal support. I said this yesterday. You know, maybe NVIDIA is the kind of the linchpin, so to say. If NVIDIA falls apart, semis probably take out the bottom, and the NASDAQ itself, you know, which is at the horizontal support level, looks very much like the SOX recently. This is going to be key. Now, remember, when you look at the moving averages on the NASDAQ, we still have red lines, okay? And that red shading between the moving averages. When we're in this type of condition, many investors say, geez, if I do buy shares, it better be on a clear entry signal, okay, number one. Number two, if they do buy shares, they might buy shares and then buy a put for downside protection. Speaking of that, last week, what you're going to notice is when I bring this up, in our class last week, we kind of talked about that. We said, hey, an investor might consider buying shares of stock and a put at the same time. Call that a married put, okay? Did any of you get practice on that? Okay, so we'll bring that up here today as we look at some of these examples. Now, I want to kind of speak to this for just a moment. Why would an investor buy a put versus setting a stop? Well, whenever the volatility goes up, you just have an increasing likelihood of getting stomped out. So let's say you bought the stock, you set a stop, and you said, I did everything right. But if that volatility goes up, you just have an increasing likelihood of realizing a maximum loss. If the VIX is in a lower end, like kind of range, which it was, the investor might say, I know that I would have a higher likelihood of being stomped out. Therefore, the investor might say, I'm just going to buy a put instead. So if the stock goes down below the long put, that doesn't mean they're out of the position. They just still have the right to actually sell the shares at the strike price. And they don't have realized losses, okay? Now, there's cons to that long put. You got to pay for it. Negative time decay. It's positive vega. You're going to see also that it has an expiration and so on, okay? Liquidity, things like that. But this is kind of very, very important. When we had last week, we go from lower volatility to where volatility spiked, okay? That's when those long puts tend to actually kind of have some more positives than negatives. We'll come to that in just a moment. Now, when we're down also in this range, the investor might say, look, I'm going to try to put on short put verticals or some cash secured puts because the volatility on these trades or markets are higher. Now, if the investor said, I'm going to choose between one versus the other, they probably say short put verticals, okay? Why? Well, because it has a built-in max loss. The cash secured put, not necessarily so, unless you buy the put to the downside. So the investor in this situation, they're probably thinking about short put verticals pretty heavily, perhaps. If they're going to buy shares, maybe dollar cost averaging, or if they're going to buy shares, they might say, look, I'm going to buy shares with a protective put built in just in case. Now, let's go just real quick to, let's say, the sectors, and then let's look at our examples. So if we look at, let's say, the sectors, and we say, what do we got here? Now, again, I'm going to go back to the trend column. If we look at the trend column, what you're going to notice is, what do we got? Well, trend 3 actually on real estate. It's not surprising, okay? Rates fell pretty dramatically, and we see real estate getting a little push. CPT, Cat, Paul, Tom, I think it's Camden Properties. Pretty nice move here today. MAA, pretty decent move here today as well. We'll look at those in just a moment. Real estate there. We also see that when you look at trend 3 in healthcare, right there, okay? And also the last one you're going to see in staples. Those are showing trend 3 on the daily charts. Now, when you look at the relative strength, there's a little bit more pockets. These are looking at the performance of the sector compared to the S&P 500. Now, those aren't any different than the sectors we've been talking about, but I want to go ahead and just take a look at what do these look like on the chart. IXRE, which is real estate, the significance is just trying to poke inside the old channel. Okay? So that's kind of something interesting to keep an eye on. It breaks inside the old channel, might trade to the upside. Now, Connie Hill, Monday afternoon at 4 p.m. Eastern, she does a class on ETFs. Kevin Horner and I do the class on ETFs on Friday morning at 9:30 tomorrow. And so just kind of keep in mind, the investor might say, I'm not going to buy an individual stock, perhaps. Maybe I'm just going to buy the basket of stocks. Now, as I mentioned, when you look at this Camden Property REIT, okay, be aware what some of the risks are to REITs in general. Pretty big bullish engulfing candle with a couple cold green chocolate chip cookies, not literally chocolate chip cookies, but you know what I mean, kind of showing a little pullback and a little bounce. There we go on that one. And if you look at the MAA, we're going to kind of see that we have like a continuation. This is the apartments. We'll look at this deeper in just a sec, but this is kind of almost kind of the continuation with the bullish engulfing right near the area of what? Resistance. Okay, now, so keep an eye on the real estate. We talked about that on Tuesday. I'm also going to kind of make mention of insurance. Okay, that's an industry group in financials. I'm not just saying the word insurance. That's industry lingo. It's literally not my language, okay? It's an industry group in the financials. That's just what it is, okay? Now, keep an eye on financials, and we're going to come back to that in just a sec. Now, when you speak of financials, one of the things we talk about frequently is what are some areas, stocks even, that maybe fell down below support, but then are maybe snapping up above where it broke down from quickly. Well, what's the significance? Well, if people are buying below support, why would you buy below support? You must think, someone must think they have enough money, or other investors see it too, that they might have enough capital to knock it back to the upside. And they're trying to use that intra-week price flux down to try to get in. They're trying to use the fear, the mist of fog, the doubt, the whole 9 yards, all the negativity. And they're saying, I hope people keep focusing on that so they'll sell their shares to us for cheaper. Do people really do that? You decide. Okay. Now, what I want to do in our first example, let's start with the financials for just a second, okay? Now, I want to speak to this. So we're going to spend a little time in financials, and I want to look at some of these stocks. Now, if you said, James, I don't know anything about financials and insurance, and where do I see the groups? Let's go to where it says, let's go to scan, okay? Excuse me, let's do this. Let's go to, let's go scan, okay? So I'm right there, scan. And what I'm going to do is I'm going to go scan in right there. So by the way, when I'm on scan, it defaults to stock hacker. And then what I got is it's going to say scan in. Now, if I click on scan in right there, if we go down by industry, there you're going to, now if you looked at this list is really by sector. okay? But then if you went to, let's say, energy, it then opens up to industry groups. So you could really say sector / by industry. Now, if we look at financials for just a second, you're now going to notice that here are the industry groups tucked away underneath the folder of financials. And you're going to see that there's a small section called insurance. And inside insurance, there's a couple different product lines, okay? Now, I want to kind of speak to those for just a moment. Now, last week, we talked about the Berkshire Hathaway, okay? And we talked about that squirting above the level of resistance. And it's still going, okay? Back, go on, okay? Now, if you take a look at this, big pop to the upside, fell down right to the middle of the green candle, seen that a million times. Second day down, only to go down to the middle of the candle again. And then if we close here, we would be trading above, or we'd be closing above yesterday's high. Which day is the lowest? It's really the 25th, okay? So why are we not getting a hold today? Well, because of the red candles. Which day is the lowest? Not even a competition. It's Berkshire Hathaway. Now, we already have Berkshire Hathaway, okay? So we're kind of riding that trend on that one. I don't want to go to that one, but that one is still going. What are we going to do with that trend? We're going to let it keep going. Now, if I look at MET, okay? Now, if you look at MET, you might say, what an absolute sty, okay? It's just a complete mess. But actually, sometimes on this, it's kind of interesting. It kind of has this up, down, okay? And we're just kind of wondering, hey, maybe could it go back to the top? Now, I want to do about 3 or 4 trades in this space, 2 of them in real estate. So let's kind of get going here. So if I zoom in on this chart, can anyone tell me what you see on the oscillator down at the bottom? Can you see anything? Do you notice anything? Well, what you're going to notice is as we drop down, right? As we drop down, the lowest point here, MACD is down at its lowest point. When we did make a low, and I'm going to arrow to that right there, the MACD was not down as far. Now, if you start to see that, you're probably starting to think that there might be a reversal, right? Now, what could kind of tell us that it's maybe starting to reverse? Well, number one, the price gets above either of the moving averages. Second, 10-period moving average goes green. It did. And what you're going to see is it did again. And what you're going to notice is it did also go green on the 20-period moving average. It did. And it crossed over. So it's kind of been like a slow-moving train, but that's not necessarily always bad. And what you're going to notice is if we drew a diagonal line to the downside, this is kind of more of a diagonal break. Now, does anybody know when diagonal breakouts tend to happen? After what type of trend? Well, if this is trend 1, we'll just label this as T1, diagonal breakouts tend to happen when you're in trend 1 going to trend 2. Trend 2 is just where the price breaks above the shorter-term moving average, the 10, okay? And you start to break above these lower highs. When you start to get a bullish MACD divergence? When you're in trend 1. So it's not all bad, okay? Now, the thing is, if we take a look at this, what I'm going to do is I'm going to right-click on this chart, right-click, buy custom. And what I'm going to do in this case is going to do it with OCO bracket. Now, in this first trade, I'm just going to do a stock trade. Some of you might say, James, I can follow you here because I do stock trades, et cetera, et cetera. Let's kind of start with a stock trade first, okay? Now, there's pros and cons of setting stops versus buying shares and buying a put. But I'm going to right-click on the chart, go to with OCO bracket. Now, wherever I right-click on the chart, that's what the price is. We got limit dated GTC, okay? Now, if you look at this, what you're now going to notice is we got the shares. Let's go back to percent. Let's type in the capital again. We've been using a number of about $6,500 worth of capital when the shares are purchased. Not always, but if we did a full position. Now, if you take a look at this, it's going to be about 76 shares of stock. If I come back and say we're going to buy about 76 shares of stock, there it is. Target-wise, that old high right there is about $87. That's if you think that it's only going to hit the prior high. If the investor says, James, I think we could even go higher. Now, let's kind of speak to this for just a second. in your life, if you buy protection to protect a car, a house, a boat, an RV, your health, whatever it is, okay? If they have tariffs, if the economy is good or bad, what does that have to do with just kind of paying for protection? The answer, not a whole lot, okay? Because for the most part, people kind of view some of those things as kind of more staplish type of items, okay? They need those things to protect their assets, literally, okay? Now, if you take a look at this, what you're now going to do is I'm going to go back and say, okay, where's this channel? One of the investors says, James, I think we might take out that high. Well, where is that high? Well, if we kind of come back, what you're now going to notice is about $79. You got about, let's lower this a little bit to be more realistic, 87. So the investor said at the earliest, you got 87 shorter term, you got 88 and a half high. But we're going to kind of forecast that it might even take out that high. You might say, this is what JB always does. He's always optimistic. I don't really view it like that. Someone asked me how I'm doing. I'm like, I don't ask myself that question. I don't even know how I'm doing. Okay. When I really think about it, maybe I could come up with the answer. It's just kind of some of the things we're seeing right now. Now, if you take a look at this, 94.65, we're going to put that target right about $94. Okay. Dated GTC. Now, I'm going to go dated GTC. Now, underneath, I'm going to kind of use these moving averages. We're sitting here sideways, and I'm right there, 81.87. And if I take 81.87, less 2% or so, it's going to give us 80.23. Okay? So there it is. Now, if we take a look at this, I'm going to go confirm send. This is done in the IRA account. So just quick heads up. The margin account has about 31,000. This account has 103,550 right now. And what you're going to see is this is a stop position. Okay, target price, stop. The stop does not guarantee the exact fill at that price. It's a trigger to sell. There's not a commission, but the capital involved, yes. We're going to go ahead and say send the order. And now what you're going to see is that entry is right there with the target. Now, if we go back and just kind of take a quick look at this, and remember we talked about the weekly charts? If you look at this on the weekly, okay, and when you're looking at charts, you want to almost really kind of just imagine that you have no positions, okay, that you cannot read news, you can't hear anything. All you're doing is you're looking at the chart. That's like a pure technician, okay? And if you looked at this chart, what do you see? So some of you are like, I don't like it when you corner me like that. Tough. That's what life is. What you're now going to notice is, if we took a look at this, it kind of really looks like a big, long-term flag, okay? So we've had this kind of just down, up, down, up, down, up, down, up, down, and you got a big, massive pull, okay, big one. Now, that ain't guaranteeing anything that could go up higher, but definitely we've had some channels, an upward channel, kind of downward channel. The downward channel, though, did not give back a lot of this move, maybe quarter of it, 35% of it, and a little blink to the upside. Now, if we take a look at this, I just want to kind of point out the MACD has not been this high in a while. Is that good or bad? Well, if you go back to kind of where we were before, I mean, the last time we've had the MACD this high is kind of when this trend started. It's a guarantee. No, we're just kind of noting that when you get kind of these big inertia moves, sometimes it might start or kickstart a trend. We're wondering if that could happen. Now, when you look at AIG on the daily chart, it does not look that interesting. It just kind of looks like kind of up and down, okay? Now, on this one, let's say the investor says, you know, James, I'm maybe not going to buy the shares. I want to have some upside potential, but I want to have a defined risk. And I'm going to go back to just real quick to the trade tab. Let's look at the implied volatility together. Let's see what we have. So first off, when we look at the implied volatility annualized on the right-hand side, it's about 30-ish into about the mid-20s. When we look at the options that are the 21st of March expiration, 2025, bid-ask spread here, 15 cents wide, 10 cents wide there. If I went down to the monthlies, April, now this is a major point. We do not want, if we do options, that all expirations that we have, they're the same. Because wonder if you had a period like February where the market goes down the last 2 weeks of expiration and all of your trades are in the same expiration. So what we're going to do in this example is we're going to go a little bit farther out, okay? Now, some of you like leaps, okay? And what we're going to do is we're going to kind of go farther out like a leap. We're going to go out to the 16th of May, okay? 78 days to expiration. Now, so option number one is you could just, maybe the investor says, I'm going to buy the shares. Maybe the investor says, I don't want to buy the shares. I want to have a right to buy the shares, okay? And with that right, it's not as expensive as buying the shares. If we pick the $77.50 call, and I feel like, my gosh, I mean, this is a blast from the past. JB's talking about long calls. I mean, you guys have seen it all here today, okay? Number one, I kind of semi-showed you a search, and I'm talking about long calls. I mean, what's going on here, okay? Is this really JB? Take his mask off. Okay, now, if we look at this, let's say the investor says, look, I'm going to try to buy that in between the bid-ask spread, 540. Now, why did you just do that? Well, if you had the right to buy the shares at 77.5, the right isn't free, and it's 540. So first off, what we want to be familiar with is, what is the break even? The key word is at expiration. The third Friday in May, which is 16th of May. Now, so anything above 82.90, positive, okay? What's the commission? 65 cents. Capital outlay, 540. Let's say in this portfolio, we say, look, we're going to buy a call and risk all of it, okay? Now, when you say all of it, how much is all of it? $540, one contract, okay? Now, what I'm going to do is I'm going to send that order, okay? And if you don't mind, so we can kind of remember where that break even is, we're going to go ahead and say 80. What was that break even? Was it 82? Just want to confirm, okay? Well, what do we got? It's 82.80. So what I'm going to do is on this chart, I'm going to put the break even at expiration. Now, whenever you buy a long call, you don't want some slow move. You want a quick one, okay? You want that stock to poke its way up through that break even as fast as possible. Now, I don't know why I'm so positive today. Okay, be negative on this next example. Well, one of the interesting things about calls, okay, and it is interesting. Now, we know that gamma is that first dollar move, okay? So if the stock goes up $1, the call goes up by approximately 65 cents. Well, 65 cents gain, potentially, on an option that's $535, that's like a 10% return on what was invested. Now, if it went down $1, it'd be a 65-cent approximate loss. Now, what's interesting about calls, okay, is if that stock goes up and we get the direction right. I mean, wonder if we got the direction right. Wouldn't that be amazing? It's 65 cents now. But if then we get that direction right and it goes up $1, the delta goes to 68. The change in the delta is gamma, the second derivative, okay? So if that stock goes up by another dollar, the delta then goes to 78. So the change in the delta, that's gamma, okay? And actually, geez, thought that was gamma. Let me actually go back, sorry. What is gamma? It's 4, not much of a difference. That's why I didn't kind of alert us there. So if we take a look at this, it would be 65 cents for the first dollar, 65 plus 4 for the second dollar. So if the stock goes up, why is the delta going up? Well, the delta is going up because, well, it's getting further and further in the money. What's the second way to look at the delta? Well, the second way to look at the delta is, what are the probabilities of the stock closing in the money at expiration? Okay. So if the stock goes up, let's say the first dollar, the second dollar, third dollar, fourth dollar, $5, $6, if that stock goes up $6, so if we're at $80 now, $81, $82, $83, $84, $85, well, that should have a higher chance to be in the money because our strike price was 77 and a half. So it should have a higher delta because it's further in the money, meaning the stock price is higher than the strike price. Okay? Now, what's kind of interesting is if we can get that direction right, if this stock moved up $6 and the gain there was about 85 cents, that's like a 15% unrealized return on what the option was purchased for. And so that's what's kind of really interesting thing about calls. So if the stock was up $6, the delta is about 85, about an 85% gain on an original investment of 530. Check my math on that, but I think that's going to be right around 15%. Let's look and see if we're correct. It's 16%. Excuse me. What was I thinking? Okay. So it's kind of interesting. If we get that direction right, every $1 move, if we get that blasted direction right, it's like 16% on the original investment. And I'm saying that, so if the stock went up to, let's say, 85 from 84 to 85, geez, that $1 move to the upside, that delta would probably be about 85. That's like a 16% gain on what the original investment was. So that's why some people like calls. But the biggest thing about calls, you got to get the direction right. Okay. Now, the biggest thing is about when might the investor consider that? They're trying to do it on breakouts themselves or prices above 10-day moving averages. When else? When prices are above 10-day moving averages. When else? When prices are above 10-day moving averages. Why is that? Hey, did you just say the same thing 3 times? Yeah, but you only heard it once. Okay? Well, so the reason why the investor is probably targeting that is because when prices are above the 10-day moving average, you tend to have short, shallow pullbacks. So the investor is targeting that so there's less time decay. Okay? Now, that doesn't mean that it's always going to guarantee to have short, shallow pullbacks, but it's currently in that state. Now, I'm going to mix this up a little bit. I'm going to go to, let's say, Allstate. Okay? And what I'm going to do here is, now, this is not the earnings coming up. This is a dividend. Now, I'm going to go back to what we taught last week. And this is a $194 stock. And what I'm going to do in this example is I'm going to do this from a long call vertical. Okay? Now, the 21st March, kind of, 22 days left. We could do that, or we could go down to the 17 Jans, and it's going to give us a little bit more time. Bid-ask spread a little wider, though, noted. Go back to this chart, and what you're going to notice is it's kind of in this trying to set up a little basing pattern reversal. We're going to go back to the long call vertical on this. That spread is 60 cents, so this is going to be very important. This is probably not some trading tool here. Spread is a little wider. We're going to right-click on that, 190, buy, vertical. Now, if we're on the call side, and if we're buying the 190, we're selling the 195, debit, okay, what the investor could lose given the vertical, we really got 275. Who cares? Well, the reason why we care is because we have a right to buy the shares at 190, but the debit, 275, so this now gives us break even. Now, the interesting thing about this trade is, but the stock is already at 194. True. So it just needs to stay where it is. Okay? Now, if we're talking about maximum gain, we need the stock to close above both strikes. Okay? Now, maximum profit, you got a $5 spread minus the 275 max loss. Max profit, 225. You got a long call and a short call, hence a debit there of $1.30. Now, here's what's kind of nice. Wonder if the market keeps going down. Wonder if it goes down and stays down. It's defined risk. Now, you also got to remember something. When someone does this type of trade, it does not have the same delta, sensitivity to direction, as a long stock position. It's kind of nice. Okay. Now, what I'm going to do is I'm going to go ahead and send this order. Okay. Now I want to go back to just real quick. I'm not going to do this, but maybe okay, hold on. Take that back. Cut that out. Just cut that out. Act like I didn't say that. If if you look at Chubb, okay, you're going to see that this one, I'm not sure how you feel, but some investors, they like these re-breaks into the old channel area. What is one of the stocks that is trying to do that? Chubb. Chubb is actually kind of the higher end insurance, okay? And today, pokey through the 276 level. Now I'm going to do this quickly because we got to move. I'm going to go back to the trade tab. I'm going to go down to the Aprils, okay? Now, when we take a look at this, the bid-ask spread, when you look at the open interest, not a lot of open interest on this. Matter of fact, we're going to go a little bit farther out on this. I'm going to at least look at it. I'm still going to go the Aprils on this, even though this has lower open interest. Let me look at the March. Yeah, okay. So what we're going to do is we're going to stick with the Marches on this because we have tighter, 40 cents. I'm just checking this. 20, 30. Okay. I looked at these real quick. Even though these have lower open interest, we're going to sell in this example. Now, remember, this is the number of contracts that are open and unexercised. Now, let's say there was a guy named Luke, and Luke sold 21 of these himself. Luke could be the whole entire world of open interest here, okay? So if this, a lot of people say, James, I don't want to represent, example given, more than 5% of the open interest. Well, 5% of the open interest would be like one contract, okay? So we're only going to do one contract. We're going to sell the 275 and then buy the 270s, okay? One contract. Now that's kind of the major point, is that you're not trying to be the market, because then you're buying and selling between yourself and the market maker or the specialist. We're going to sell the 275 Aprils, buy the 270s, okay? $1.60 credit, and see if this can't get a little reversal here to the upside. Now, what I'm going to do also here is I'm going to send this order. Note that commission. We're still in the IRA. We're going to send that order. Now, I want to go back to just real quick some of the questions and some of the Dow stocks. When you look at some of the Dow stocks, even some of the stocks in the Dow, Triple M, getting a little squeeze on the moving averages, a little poke, okay? Now, Kevin Horner did talk about this, and if we take a look at this, I don't know why. I always like to kind of mess around with Kevin a little bit. It's so fun. Now, if we take a look at, let's say, Triple M, that's really kind of the breakout of the flag as well, okay? Now, if we take a look at this, we go to another one, which is kind of in that same area, financials, not insurance per se, at least maybe not the bulk of their business. Another stock that's maybe coming out of a basing pattern itself. When you go look at this, that's not earnings, that's dividend, okay? And you got like a prior high. When you back this chart off for just a second, prior double peak high, really right around about the 267 threshold, okay? So that's another one that maybe the investor might kind of keep an eye on, okay, as well. 2 days ago, when we had that candle where we breached the 250 threshold, that also was higher volume on that, noted. Yesterday, we did not get to above, or we didn't have high selling volume, as we were below that yellow line there. And I'm down right there and I'm pointing at it, okay? Now today, lighter on the volume, the key word is so far. That's another one we're going to keep an eye on. Mickey D's, the double arches. That is actually one that really breached its old resistance, kind of plateaued, okay? Now, what you're going to notice is we're kind of in between the gaps, where we gap down from and where we gap down to. True? But we're kind of hanging in there. When we fell down below that support level, it only was down below that support level for a day. Yesterday, big red candle. Today, firing right back. That's another one we can keep an eye on. If we said in a week or two that this stock went up, would it be maybe a surprise? You might say, not really. That one kind of looks like it's something that might try to get some mojo here, get a little bounce. If we look at the weekly chart, we have a red candle, okay? On a hammer candle, it could be green or red. This was red, and it fell down right to the moving average line and then pushed back up. Ladies and gentlemen, boys and girls, that's a hammer, okay? On the weekly chart, bouncing off that shorter term 10-day moving average. And last but not least, when we also take a look at, let's say, Starbucks, okay, you're going to notice that was a brand new high. Still have that position on Starbucks, and that's just kind of like grinding to a brand new high. Now, a lot of these examples that we looked at here today, and I'm going to include MAA and Camden Property and some of the insurance companies and things like that, Mickey D's, Starbucks, they're kind of like staple-ish type companies. If the economy is strong or not as strong, people are probably still going to probably use it, okay? Now, the biggest actually thing is here, that doesn't mean that the stock goes up, but what you're going to see is the companies, the stock symbols we're looking at, they kind of have that staple-ish type product or service. And the biggest thing is here is the stock prices have actually been doing okay, okay? Now, first off, when we go back to questions, yeah, Riceberg says, you mean KTH, Kevin Taco Horner. That's correct, okay? Now, I want to go back to just real quick, one of the questions that came up, and let's go back to NVIDIA for just a second, okay? Now, there was a trade that we did on the NVIDIA. We sold the February 132 put, and I'm right down here at the bottom left, and we sold it for 320, and it's at 535. Now, if you look at the out of the money put, out of the money, the 120, okay, has 1 day remaining. So if we looked at that position, said NVIDIA did not gap up on earnings, it actually went down. That position, if you really look at it, is down $2, or I should say this, $260, $270. So we got 1 day for this to close back up. Now, what's the risk to this trade? Now, if this was a real trade, which is not, it's paper money trade, what's the risk to the trade? Well, if you got the stock at 127 and you got a short option at 132, what could happen? Well, it could be assigned. What does that even mean? It means we could own 100 shares of the stock at 132. Now, what's going to happen potentially to the 120 put? That 120 put most likely will expire worth less if the stock closes above that strike. No intrinsic value. So we got 1 day. Now, if the investor said, James, I don't want to risk it. I'm out of time. Matter of fact, it doesn't look that strong, okay? The investor might say, James, I don't want to risk it. I just want to get out of the trade. I'm willing to accept that $268 loss. It did not bounce to the upside. I'd rather have a fraction of the max loss than something where I get assignment of the shares and have a bigger loss. Now, wait, I don't like to take any loss. Well, then I don't know why you're investing. Because we know in the world of investing, sometimes you're willing to take a loss or a portion of the max loss. So in this trade where we're just out of time, we're going to create a closing order, buy it back, and the investor is going to say, you know what, I don't like it, but I'll eat a little slice of humble pie and maybe take a half of a max loss. That doesn't taste any better, but it just didn't bounce to the upside. We're going to buy that short option back so that way we take the risk off of buying the shares at the strike price or getting it assigned to us. And now what we're going to do is the last remaining trade, which has more time, is going to be those ones right there, which is still on. So we had 2 positions over the earnings there. Now, I'm out of my time here today, but I just want to answer that question at the end. But we did pull that off with 1 day remaining. Now, I want to kind of give you a quick reminder that coming up next, let's actually pull this back up. So the next class we actually have, we have Short Verticals by Connie Hill. Getting started with stock investing, Kevin Taco Horner. Thank you very much. And we also got Barbara after the close. I want to say thanks to Brent Morse for answering those questions in chat, and thanks to all of you as well. So stay tuned for our next webcast coming up next. And also remember that if you have not subscribed to the Trader Talks YouTube channel, just go to that link that I just sent to you And right in the middle of the page, if you have not subscribed already, it will just say subscribe. That we can see all of our content outside the 2 ETF classes. So with that said, remember with what we discussed, it was done for example, illustrative purposes only. All investing involves risk. Be aware of that. And as we've talked about that, hopefully it's kind of helping you kind of understand different type of strategies as well and defining the risk. This has been the class on Trading the Trend. Stay tuned for our next class coming up next. Take care. Bye-bye.